Today we're going to go more in depth again with the 12 candle rule in our 50 pip simple FX trading strategy. Stay tuned, traders. We'll be right back. G'day traders, Stacey Burke from Stacey Burke Trading. Hopefully everybody's had a good start to the week. It's Tuesday, and today we're going to be going a little bit more again over the 12 candle rule. A lot of traders have been emailing and asking questions again about the 12 candle rule. And I want to re-emphasize the three things that markets do. We talk about a breakout, pullback, and a continuation. We call that a trend trade. So often we'll see a market possibly break out of a 100 pip box, pull back, and continue that move, or burst up through the top and layer on top for a continuation, usually in that Europe open. We talk about a breakout, a false break, and a reversal where we could see the market come down, hit it again, and pull back and reverse to the other side. It might even be a 1, 2, 3 to the high of an existing high and then a reversal. But typically they will reverse and go back to the other side of the range or to the most recent high or low. And the third thing, of course, is a breakout, pullback, and then a market that goes into a trading range. So it's really important that you don't let the price distract you or confuse you about what the market is really trying to do. So they will use a lot of candle formations around the price that they're actually filling at or filling underneath of or on top of for the move back of where they really want to go. So again, I talk about identifying the high and the low of the day. We in our daily FX videos, first and foremost, we want to sort of identify in that session where there are existing profitable trades, because again, that's where the money is. And those where the money is sitting, any trade that's in profit, if they've moved their stop to break even, the market will inevitably go back to get them, whether it's in the initial Europe changeover or in the London session. If they're working, you know, traders, we've talked about, are they working the low or are they working the high? So if the market has come down towards the end of Asia, they've painted a high, they've broken through 50 and they're working towards the bottom of the box. I call the box the 00 to 00. These numbers are the price. So again, one of the questions is, what are these 00s? That is the price. Round numbers, 50 00s, 100 pip boxes. If the market is bursting to the low through that box and we paint a pin in that first hour, we come down in 3 bursts and they're at 00s, that has my attention. If the market's inside of a range and the high and low aren't near where the market's at, and they give you a little pin bar or some candle that looks like a price action pattern and you're in the middle of a range, I will ignore that pair, because I know until it gets to numbers or to a high or low, that market has not set up properly for me to look at it for a high probability trade opportunity. It needs to be at numbers or at an existing high or low of the day. So again, the previous session's low or high. What's important about those is that when you're inside of a previous day's range, those areas that have acted as support or resistance previously can do the same thing in the session that we're currently trading in. So it's important that if the market bursts through a previous low of the day, the next question is it finding some degree of two-sided trading there? Are we at numbers? Is it going to reverse back inside? Or are they coming down to continue that move, trap traders initially in that Europe open in the wrong direction before continuing down? Or are they working the low? So it's important that you're patient, and that again, we talk about focusing on that hourly rotation. So okay, we have a hypothetical setup here. So the market has come down. Until this candle has printed, we do not have a low of the day. This bullpen hammer means nothing until the market has given us either a previous low that this is traded into and failed for a reversal back up, or it goes 1, 2, 3 into the London Open, and then all of a sudden we have traders who want to short this engulfment going back down. This is a trap you will often see, is an engulfment pattern jamming traders in down low in the wrong direction before they reverse the trade in the direction they actually really want to go. There's a hypothetical double bottom at the previous day's low, at round numbers. Now the next thing that the market may do is pin down inside of that engulfment to put stress on traders on a 1 minute chart. They might be filling a gap, whatever. But this combination of a pin hammer beside an engulfment is one of the most powerful combinations you'll see, and it might be at the end of that third hour. But if we put an hourly chart up, what we would, again, if you look at your hourly charts, you'll see some kind of pattern of a bear candle down, maybe an inside bar or a doji bull pin, and then on the third hour a smaller bear candle, and then a bull candle that prints going in the other direction. So again, one of the things I want to emphasize with all of these is to wait for the candles to close. And the reason why that is that this market will often get traders chasing. Before this was a bull pin, this was a bear candle that was hanging down here, and traders think they're missing the breakout or the runaway market. And then in the last 10 seconds, sometimes in the last 10 seconds of a 15-minute candle, this bar will pull up 20 pips and close up inside of that double zero box. It happens all the time. Wait for closed candles. So structure, okay, where's our bigger picture? Are we in any kind of geometrical pattern? Have we had a peak formation? Are we in a big rectangle? Do we have three bursts for a symmetrical or a descending triangle, ascending triangle? Have we had any sort of head and shoulders pattern on the 2-3 day setup structurally in a big picture? Where's the previous or the current high and low of the day? Okay, have we violated a previous yesterday's high or low? Timings, okay, this 12 candle window. I will repeat this. If you haven't seen any other videos, go watch the 12 candle rule videos. 1 hour before the market opens. So if Asia opens at 8:30, that means at 7:30 p.m. New York Eastern Standard Time. All times are New York Eastern Standard Time. 1 hour before, that's 4 15-minute candles. Then the hour of the market opens. So if it's London, and that's our window is 2 a.m. to 5 a.m. And I have said on occasion, if the market has moved 50, 100 pips and consolidated over a few hours into the end of the Asian session, I will go to that market for the last maybe 2 hours of Asia, because if it consolidates for a couple of hours at a level after moving, chances are we could get a big coiled spring for a huge trending day that leaves at the end of Asia before we get into our 12 candle window. This 12 candle window will allow us a second entry into a market that's already probably moved 50 or more pips. So, timings, 2 a.m. to 5 a.m. New York Eastern Standard Time, and then New York 8 a.m. to 11 a.m. New York Eastern Standard Time. That window in between that 5 a.m. and 8 a.m., often if the market has moved, we've talked about 3 hour blocks. So if the market has moved 50, 100 pips in this Europe-London changeover session, and we have an hour or so prior to the New York Open, chances are if the market has consolidated, 50, 100 pips up, that we may have a 50 or more stop hunt back into the trend. If that market continues to extend out in the trend, chances are that New York will actually reverse back into the move. And we've seen some very big moves in the New York session, up to 400 pips, pound Aussie last week. They will make sure a lot of those profitable trades get stopped out with nothing or at a loss. So make sure you're taking profits. Okay, we work from round numbers, 50s and zeros. If you've been following me long enough, you know that these markets go off the numbers. The only exception to that is the high and the low of the day. 12 candle window, again, 90% of the trade opportunities day in and day out to get 50 pips or more happen in this 12 candle window. So again, when the market sets up, whether it's up top, down low, at a high, at a low. We're looking for the market to exhaust itself into a level, not trade into it and pull away and think that we've missed it and we need to chase it. That's what they want you to do. They will move away quickly, make traders chase fills far away from the price, only to get jammed up somewhere and they hit the low or the high again. Sometimes this structure will actually take 3 hours to set up. So think about what's happening. They're jamming in traders in the wrong direction with false signals over that 3-hour block to build up volume that they can trap and then shift the market to move it for 50, 100, 200 pips. Now we've talked about doing measured moves on profit targets. We're going to get into that in a different video. But again, risk management. If we're going long here and we want to go this way, it's a 1-bar stop right in here. That's our stop. If our thesis is that if we're going long and we're right, okay, this market, that's our maximum stop loss. But we're looking at maybe 3-4 times the range for our profit target. So I want to be wrong as fast as possible. If you haven't read Peter Brandt's books, we've talked about this, asymmetrical risk reward, that's the whole point. You're targeting geometrical measurements of your trade for profit targets. So you get stopped out, so what? You go on to the next trade. If you didn't trade it properly, okay, so what? You made a mistake, you didn't read it well, get better at reading that. We know now that the bulk of all of this stuff comes down to how well you're able to execute. So I'm not trying to trade one pair every single day and catch every move, okay? I don't sit there and look at the pound or the pound yen and go, I missed that today, I'm stupid. Who cares what that pair looked like? If it wasn't right, look for the best pair out of the 6 or whatever pairs you're following. You should be able to have at least 4 to 6 pairs up there with a couple of simple steps that you're looking for. The first thing that filters out a pair for me right away is whether or not it's near a high or a low or at numbers. If it's not at numbers, I'm not really even interested because I know the best trades tend to come off the round numbers. So focus on the best setups, but don't be afraid to follow 4, 5, or 6 pairs. If you can follow more, fantastic, all the power to you. The next part of that is I'm not looking to try and take 3 or 4 trades on different pairs. I want to find one trade, one good trade. Mike Bellafiore talks about this in the playbook, in One Good Trade. Focus on mastering one good trade and executing that perfectly, getting really good at it, scaling it up. Okay, so they're going to throw a ton of variables at you every day. They're different. Every single day looks the same, reacts differently. They might have moved it up one day, it looked very similar the next day, but then they went down. That's where the live time skill development comes in. And now you know, if you've been trading these markets long enough, how they burst the price, they'll use momentum, they'll flash the price, they'll wick it up and down, they'll widen the spreads, they'll hold price at a certain level, they'll flash it, and even when you're in the right direction, they'll come back and hit you a few times to get you to shake you out. Yesterday's a great example, pound New Zealand. It finally broke down from double zeros, went down 50, 60 pips, and they, in one candle, came back up 35 pips. Enough to shake out traders who were in the right direction if they hadn't taken profit. So they covered the trade, and the next candle immediately went back down in the same, or in the opposite direction, 35 pips back down, and then it continued its move towards the bottom of the double zero box. They will use all kinds of tactics to shake you out of trades when you're right. So I had a comment on one of the videos today. How does show us some back testing? You cannot back test live performance because live performance is discretionary. You can have the same setups, the same traders. You can know exactly what the setup is, and traders will still not trade it the same. Some traders won't even take the trade. Some traders will get in the trade and go to break even and get stopped out after 10 minutes. Other traders will trail it and get stopped out. Other traders will position themselves in the market with a stop loss and a target and walk away and get 100 pips. Other traders won't do that because they're not comfortable not knowing and sitting at the screen, thinking that sitting at the screen and staring at it is going to actually change the outcome of that trade. You cannot control the outcome of the trade itself. You can only control execution of your trading plan. So backtesting means absolutely zero, even if you have an algorithmic system, because the market is never going to be the same going forward. So even an algorithmic model will have phases where it expires because the market conditions expire. As a retail trader, even if you're using those, you cannot trade big enough unless you've grown that account to a certain size without going through choppy markets and having drawdowns from multiple losses in a row. Then obviously making money back when it trends again, or if it's a mean reversion system, whatever. There are a lot of variables that the retail trader has to deal with that large institutions don't, because of the size of their capital that they can use to allocate to multiple systems, and they run multiple systems simultaneously because they're concerned about the aggregate amount of the outcome of all those systems running together. So there's a lot of little things that sound good on paper, but in live time it doesn't work out that way. But as a discretionary retail Forex trader, these are the things. If you simplify this right down to taking yourself that 12 candle window, make sure that you aren't trading all the other stuff that's designed in a lot of cases to trap you into these markets where eventually they shift and either stop you out, they jam you in with 10 pips of profit. The other question you want to ask yourself is the market bursting to the numbers or to the higher low in bursts, or is it creeping? If it's creeping, do we have any sort of 1 push, 2 push, 3 push scenario for possibly a double bottom reversal? Or is it trending, making new lows, rolling underneath of lows, that sort of thing? If it's bursting, chances are we're in a blow-off or a stop hunt. If it's creeping, it's building up energy for an explosive move. So creeping trends will often end in an explosive move, either north or south, one of the two. So keep it simple. Focus on timings, okay, in that window in your head. If you haven't seen a setup, just be thinking. Like I told you before, I write down numbers 1 to 12, and I look at all 6, and if there's nothing, tick the box. Nothing. If there's a pair that shows an engulfment, a pin hammer, we're at double zeros, we've got a second hit to a high or a low, 1, 2, 3, whatever that may be, then I'll put it in the box. Now you've got my attention. Now I'm looking at that pair. I'm looking, maybe if I'm looking at the pound Aussie, I'll be looking at the pound New Zealand to see if it's behaving similar. If it's at numbers, is it setting up for a move possibly in the same direction? There is a bit of correlation there. If it's the pound yen, I'll be paying a bit more particular attention. I don't like to trade that pair unless it's at numbers or at the high or low, because it reacts a little bit differently to numbers. If it's the pound, then again, high and low, round numbers, it's very specific to that. Pound Canadian, I might be looking to see if there's news and looking more towards the US session for that pair to move. It tends to move very strongly, the Canadian dollar, in the New York session. So if that's the case, I'll be looking at the pound Canadian a bit more suspiciously in the Europe changeover, unless it gives me a textbook setup. So I'm trying not to trade, because I know most of the time, unless it's really straightforward, the market will drag it out over this 12 candle window. So the closer we get to the end of that 12 candles, the more likely I'm going to be in the right direction of the move, which is why I do the daily FX levels. It gives me a bit of a thesis, lets me be a bit more thorough. I can identify where the money is, and then when the market turns it on in the Europe Open, if it's completely against what I originally saw, that doesn't mean I can't change tact and have a different perspective now, but it gives me a model to approach the market with. And then when we get our 12 candle window, how does that go with our thesis? So yesterday the pound Aussie, pound New Zealand fell right into the thesis, so I stuck with my original plan and traded those pairs. So develop a little system where you can have a checklist, identify where your highs and lows are, look where the numbers are, look at the timings, use your 12 candle window, look for simple price action patterns. Again, engulfments, pin hammers, double bottoms, double tops, shift candles. We'll go over more of those, but for the most part, keep it as simple as possible. If you do that, you can duplicate that. If you're using all these different indicators and even sometimes EMA crossovers, will trap you in the wrong direction if you're not paying attention to the highs and the lows and the numbers, because they'll make you chase things and then pull back. And even if you're in the right direction, these candles right now are large enough on some of these pairs that your stops are going to be 50 pips. And that's enough to put the brakes on most retail traders unless they're using a micro lot. So just master the trading process. Keep it simple. Focus on these 12 candles. 15-minute bars, and keep an eye at the end of each hour. If you want to check your hourly charts at the close of every hour, do that just to see, is there a pattern on there? Is there an engulfment, a pin bar? Anything that could indicate your thesis about the direction you want to go, or negate it and get you to have a different perspective in case you're looking at it the wrong way. So keep it simple, traders. Focus on closed candles. Look at the hourly rotation. Look for the best pair. Keep it simple, and just focus on executing your trading plan as flawlessly as possible. Again, thanks for all the great feedback. Keep it simple, traders. 1% improvement every single day or every single week. Just focus on getting better. Do not focus on the money. Focus on getting better at trading. Have a great trading day, and may the markets go with you.
Good day, traders. Stacey Burke from Stacey Burke Trading. Just going over a couple of examples from yesterday, Monday, April 6th, 2020. Monday, looking at the pound Aussie. The pink is our 12 candle window between 2 a.m. and 5 a.m. New York Eastern Standard Time. The market broke through the previous day's low, initially opened up on a gap, traded back up off the previous day's low before breaking down in Asia, and then working its way back into the previous low of the day, up to 50, dropping down to double zeros, dropping down through the double zero box with a pin hammer at the open of that Europe changeover. This is where it's important to pay attention into which direction are they working. Are they working down into the low, or are they working back up into traders who have shorted this market in that Asian session? Clearly, they were working back up, 1 push, 2 push, 3 pushes, pins on top, and then rolling over with an engulfment candle at the end of that 12 candle window. Traders, if they weren't positioned anywhere up near the high, could have taken a trade on that continuation engulfment back inside of the double zeros. And again, timings, 12 candles. Traders may not have been in this area. They may have waited that 1 or 2 extra candles expecting something like this below the double zeros, then possibly either fighting for best price, placing their stop above that high, then either targeting a measured move of their breakout or trading from the numbers. Again, I talk about trading 2 times the box. If the market's in a 50 or 100 pip box, we're looking at possibly a 100 or a 200 pip move. Pound New Zealand, very similar. We see the market selling off of the blue tracer, the previous day's low, up at 50 in the Asian session, making new lows, and then auctioning back up, 1 push, 2 push, 3rd push engulfment. Traders again forced with either chasing the decision to chase price if they weren't already in the market at double zeros with a 1 bar stop, or trying to trade in the pullback and getting the best fill they could in the same scenario, 50, 75 pip box, looking at a 100 to 200 pip target. You can see the market immediately came back to stop hunt traders, to shake them out of a winning trade. If they hadn't taken any money off, they may have covered this or been stopped out at break even, only to painfully watch this market continue to move down another 100, 150 pips. So again, if you have a position in the market, be confident to hold on to that until it does a second tap to the low. If it's a breakout trade in a strong trend, these are all the discretionary type decisions that you're forced to make in live time. Again, we look at the pound yen, an example of a market that took off early towards the end of the Asian session. It had layered back up inside of that 100 pip box on the previous session's low before the gap opened on Monday, taking off, 2nd push to the high, 3rd push to the high. The US session hit at 1, 2, 3 before dropping down late in the session. The pound, very similar, broke above at the end of Asia above 50, giving pins, trapping traders short, trading back towards the original trade, only to have an engulfment candle, 3-bar pattern set up, trapping traders going in the wrong direction. Again, this bear candle down is the end of the 9 o'clock hour. The next candle opens at the beginning of the hour on an open drive. It's important to pay attention to the timings of these trap candles. Market moves up 50 pips, second hit, third hit, consolidating at numbers, dropping down in the US session before hitting the highs again into the US close. Round numbers for the sell. So if you've missed the move in Asia and you're in the middle in the Europe-London changeover, this is where they will get traders to chase the trade, trapping them up high, jamming them in, jamming them in, jamming them in, jamming them in, and then shifting the market. So keep it simple, traders. Look for pairs where you're working around the numbers, possibly trend trades, continuation moves. The pound Canadian gave a nice little double bottom that gave 50 pips up before retesting and stop hunting traders that were long, hitting the high again, hitting it one more time in the US session before consolidating, giving an engulfment, an example of a trade that started in the middle of the box after jamming traders in to the highs. That trade then moved 150 pips down. So keep it simple, traders. Look for these markets to exhaust themselves at levels. You can see clearly we're inside of a 100 pip box, and may the markets go with you. Have a great trading day.
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburktrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.